Ladies and gentlemen, welcome back. This is Christopher Aaron. It is June 18th, 2020, and I'm fairly excited. We are going to have an examination of the gold price and the gold miners in this update. Now, we've been talking about some major global macro signals here on this channel for the last several weeks. You will know what I'm talking about if you've watched the last several videos. We were talking about that signal which hints that something like a depression is setting up in the world economy over the next several years. In the premium updates, we've been talking about some other signals that we're looking, such as the Dow to gold ratio breakdown. Very important stuff happening. And I am really excited because these signals are hinting that gold and the gold miners are going to be two of the best performing asset classes in the world over the next 3 to 10 years, is my best estimate. Now, there could be and there should be something of a pullback setting up in the gold price for sometime later this year. But after that, it looks like gold is going to be one of the leading asset classes in the world. And the potential here is truly significant in what is setting up for the gold miners. And I want to show you that in the clearest way possible, which, as you know, on this channel, we are focused on looking at the data and what is actually visible to us in the data set. By the way, this is the Super Pit gold mine in Western Australia. Fine example. This used to be one of the largest open pit gold mines in the world. I think it's now the second largest example of an open pit operation there, digging for gold, which is what we will look at in this update. I want to remind you to hit the big red subscribe button before you go any further, and make sure to hit the little bell notification so you will get notified when these updates come out. So I want to start by looking at the gold price here in the last 3 days, and we are seeing something of a continuation in this consolidation that we've seen. And so it looks like gold is going to continue in this kind of holding pattern here for the short run. I don't see anything on the radar screen. You know, we had the Federal Reserve meeting 1 week ago. That was not enough to get gold out of this holding pattern. So we will see what happens with weakness in the stock market or further continuation in the number of cases in the coronavirus. We will see what can get gold out of this holding pattern, either higher or lower over the short run. So let's say that you, as an investor, already have a core holding, a sufficient core holding in physical gold. And we can bring into that equation physical silver. I think both will perform well, but I think gold is going to continue outperforming silver for the intermediate term. And so what I want to do is I want to talk about gold here in this video. If you have a sufficient core holding in gold, and I always recommend that investors have a core holding of gold, and this is going to be a different amount for each individual. You know, if your portfolio that you're talking about is a $10,000 portfolio, that core holding in physical gold might be somewhere around 10%. It might be somewhere around 20%. If you're talking about a $1 million portfolio, that core holding might be slightly less than that range. I have some investors that we work with where their core metals portfolio is more like 25%. And this core holding should be something that you're not looking to trade in and out of. It should be something that you have accumulated throughout time and that you are holding until the revaluation in the metals is over, which could be 2 years from now. It could be 10 years from now, right? The point is that you hold this, and then when an opportunity comes about, when gold is properly valued again, you can then use that gold to buy other assets such as real estate or such as other businesses, et cetera, et cetera. So the core holding in gold, you are not trading at this time. If you do not have a core holding yet, we should speak about that because you want to make sure you have your core holding set so that no one can take that away from you during the course of what looks like it's going to be a bull market. Now, All of that said, assuming you have that core holding, we have investors here who are new to the sector for the first time, and they're saying, what about these gold miners? What's the big deal? Why are we talking about these gold miners so often from time to time? And I want to show you the reason why, if you already have a sufficient core holding in the bullion, you may want to consider owning some of the gold miners. And so what we're looking at here on the top is the price of gold in US dollars from the all-time high in 2011 through the present. And what we're looking here at the bottom is an index of the senior gold mining companies. This is an average of about 25 of the largest gold miners in the world. Same time frame. And so what we're looking at here is the clear stage 1 base resistance. Notice this 6-year kind of swooping curve here, but notice the 1, 2, 3, 4, 5, 6, 7, almost 8 times that gold was unable to break out of this stage 1 base resistance for 6 years. And then notice the significant move here after the breakout occurred in July of last year. And then we're looking at the same thing for the senior gold miners here, this stage 1 base resistance, except this has now been going on for 7 years. And depending on which index, right now we're talking about the HUI index, which is the purest index of senior gold miners. We could also consider the XAU index, which has a bit more silver exposure, and we can consider the GDX index, which has a wider range of also some mid-tier gold mining companies. But right now we're looking at the HUI, which is the purest senior gold miners index. And so what you can see here is that this index still has not broken out. Now, in the premium updates, we've looked at the entire history of the times where this index has lagged the gold price as far as breaking out. And we've looked at a number of examples like that. Could this be setting up for a long-term top? Yes, it could, but it's also possible that that top comes from much higher prices. And so what we want to do is look at what is the potential here if one already owns a core holding in physical gold, and you're saying, let's just be realistic about this for a moment. Let's not talk about 3,000 or 5,000 or 10,000 gold yet. Let's just talk about getting back to the previous all-time high at 1923, to be specific. And if you're looking at buying physical gold now, absolutely nothing wrong with that. If it's a long-term holding, I wouldn't buy all at one moment. But what is your upside? What is your upside just for a realistic target here to get back to the previous all-time high? We're talking about a 10.1% gain to get back to that 1923 level from the 1735 that we closed today in the futures market. 10.1%. Now, if the senior gold miners are eventually going to match the relative performance of gold in getting back to that respective 2011 all-time high, there is a much more significant move ahead for the senior gold miners in percentage terms compared to gold. How much more significant? Let's look at it. From where we are right now at 261 on the index of senior gold miners up to the previous all-time high just below 640, this would be a 146% return over a doubling, right? A 100% is a double, so greater than a doubling in the average senior gold miner just to match a 10% return to the previous all-time high for gold. Can you see this? So, again, the point is, if you already have a sufficient core holding in physical gold, I am laying out the metrics here which show that if you're looking to try to get some leverage, trying to hit some home runs, you may want to consider diverting or moving some of your more speculative funds into the gold miners, which have a much more significant potential for revaluation just to get back to the previous all-time high. Now, let's flip it over and not talk about the senior gold miners. Let's talk about the mid-tier gold miners. We're looking at the exact same chart on the top. This is the same chart of gold that we just looked at with that 10.1% gain needed to get back to the 2011 high. What about the mid-tier gold miners? This is the GDXJ fund. This has junior but mostly mid-tier gold miners. The mid-tier gold miners, you can see, are lagging even the senior gold miners. The mid-tier gold miners would need to rise by 225% to get back to just below this 145 level on that index. Okay, so if one believes that gold is going to be matching its all-time high, let's say not this year, maybe there's a bit more to go, and then there's a pullback into the later part of this year, and then let's say gold gets back to its previous all-time high next year in 2021, there is something to be said for evaluating the suitability in your own risk and reward tolerance for having an allocation in the mid-tier gold miners. I would certainly say if one is ready for a 10% move, one should compare that to the possibility of having a 225% move. Does this make sense? We're talking about the companies that dig this out of the ground. They are intrinsically related. The gold miners are leveraged to the price of gold because, all things considered, if you have a company, well, let's say it costs $1,000 to get gold out of the ground per ounce, and let's say the price of gold is trading at $1,000, we can see that that company would have very little profit, right? If gold was at $1,000 and it cost them $1,000 to get that gold out of the ground, very little profit. Let's imagine that the price of gold goes from $1,000 to $1,500. Suddenly, that gold miner has an infinitely larger profit than they used to have when they were struggling to make a profit. So these companies, their profits are very leveraged to the underlying gold price, and there should be a significant catch-up potential for this over the year or 2 or 5 or 10 ahead. One last example I want to give you here. If one is saying, well, okay, so we could look for 146% return in the senior gold miners, a 225% return in the mid-tier gold miners. What about the pure junior gold miners? There is no index which covers the smallest spectrum of the gold miners. I'm talking development and exploration. Even the so-called junior gold mining funds do not own any development or exploration companies only. So you really have to dig around to find them. And please be very careful who you listen to about these junior gold miners. There are approximately 1,000 of them out there. So if you're just stumbling upon one name, think about it. You stumbled upon 1 out of 1,000. Are those the kind of odds that you want to take? I do want to tell you, I want to give you this example. I'm not going to reveal the name. I'm going to call it Junior Gold Miner X. And this is a company, by the way, that we are planning to invest in here over the very near future. And you can see this company, from where it used to trade at 2011 at the peak in gold, up at 87 cents per share, falling all the way down to where it is at 10 cents today. For this company to return to its previous 2011 peak, assuming this company is still sound, which I happen to know that it is because I've done extensive research on it and I've spoken to the management and I've studied this deposit extensively. For this company to be properly revalued with a 10% move in gold back to the previous all-time high would equate to a 770% return. So, guys, think about this. Step back here for a moment. I'm just asking you to evaluate your own situation. If you have enough physical gold now and you have some, let's call it risk capital, where you're saying, you know what? Yeah, a 10% return would be nice. It would preserve my purchasing power. But what about the possibility of something like this? Nothing is guaranteed in the world, in the investment world especially. But if you're saying I have some capital that I am comfortable taking a risk with, I'm arguing that there's something to be said for allocating a portion of that capital into the spectrum of the companies that are still within their stage 1 base resistance and that could stand to have life-changing revaluations over the next 3 to 5 to 10 years. We have just looked at those signals. I'm not making this stuff up. Go back 2 videos ago and think about the signals that we were talking about with respect to gold, the gold to silver ratio breaking out, how that ratio was last seen at the very beginning of the Great Depression. Which assets performed best during the Great Depression? Gold and gold miners. I'm not making this stuff up. We're seeing these signals again. So please take the weekend and really sit down and evaluate your situation here and think about, is this something that you should get more involved in? It's not for everyone, but for some people, I'm convinced there are just going to be incredible opportunities in this sector over the years coming up ahead. And I think we're within 12 to 18 months of gold hitting that previous all-time high and then quite likely breaking through it this time. I wasn't saying this a year ago because the signals were still mixed, but we are seeing signals now that cannot be debated. If you would like to learn about the exact gold miners that we are buying and selling here, as well as that company X that I talked about, you can find out more about that, as well as all the research on the companies that we invest in. We don't just throw darts at a board. We do extensive research here. We cover that. We cover gold, silver, the US dollar, the stock market, the commodity sector. All of this goes right to your inbox. We do weekly members-only videos as well to get you up to speed on the broad picture global macro landscape. Make sure to check that out if you're serious about investing in this sector. I can't imagine personally investing in it without looking at data such as this, such as you've just seen here in this video, showing those revaluation percentages, and we update that fairly regularly. So I really want to encourage you to think about that, whether this is appropriate for you, whether it's appropriate for you to continue just tuning into the free videos. Either way, guys, really think about your own situation here. This is what I'm doing with my own money. That's all that we publish here. It's just what we're doing with our firm's capital. And we publish the research and the analysis. And I hope it provides some value in your journey for yourself. If you would like to speak to me one-on-one, I want to let you know that I do work with individuals from across the spectrum. I work with people who are just starting in this sector. If this is the very first time that you've ever thought about a gold miner, about purchasing a gold mining equity, and you literally have no idea what I'm talking about or how you would go about doing it, I'm there for you. We can talk for half an hour. It's a fairly reasonable amount of money. I would say my consultation fees to bring you up to speed on where you need to be. If you have a multi-million-dollar portfolio that you're looking to diversify amongst the precious metals, I work with individuals such as you as well. We sit down, we iron out a full plan, what I would do in your situation, what sort of feedback can I give you from someone who has studied this market here for the last 15 years. And I take no fees from any of the companies or any of the funds that we profile. I simply look out for the best interest in you. I will not get 100% of things right. Absolutely not. No one on this planet will. But what I can offer and what I can promise to offer is a researched, a data-driven, independent perspective. Once again, make sure to hit the subscribe button and the bell to stay notified. And I want to thank the people who are supporting this channel on Patreon. It means a lot to me. You can send requests for future videos, and I try to honor those requests as best as I can. I really appreciate your support. Think about your situation carefully this week into the weekend, please. It's an exciting time. I would say, we're seeing that consolidation in gold. The best time to come up with a plan of action is when the markets are a little bit slow. You don't want to be panicking once gold is moving higher, or let's say if we get that nice dip later on this year. You don't want to be without your plan when the markets start getting more volatile again. So come up with it now, and I'll see you there.